Good morning, friends. Welcome to day 10 of our strategy, cost management, and performance evaluation crash program. In the last session, we were dealing about chapter number 9, divisional transfer pricing. And in the last session, we were doing problems from the exercise questions from the study material, and we have completed up to question number 4. Now, we need to quickly complete the remaining questions in the exercise of chapter 12, and then we need to move forward to the next chapter. Okay, so right now we will take up with question number 5 in divisional transfer pricing. Okay, you can read the question, then we will read the question once again. So you can pause the video and read the question once. Okay, yeah. Now what is given in the question? Let's see what is given in the question. Okay, Great Vision manufactures a wide range of optical products including lenses and surveillance cameras. So Great Vision is an entity, and this entity is manufacturing. What does it manufacture? It manufactures wide variety or wide range of optical products including lenses and surveillance cameras. Okay, then Division A manufactures the lenses while Division B manufactures surveillance cameras. Okay, so you have what? You have Great Vision, and Great Vision has two divisions, Division A and Division B. Okay, now what does Division A do? Division A is manufacturing what? Lenses. Manufactures lens. On the other hand, Division B is manufacturing surveillance camera. Surveillance cameras. Okay, right. Now going forward in the question, the lenses that Division A manufactures is of standard quality and that has number of applications. Due to huge demand in the market for its products, Division A is operating at full capacity. So what is this? It says that Division A is having huge demand where? In the external market. Okay, due to which it is operating at 100% capacity. Okay, now going further, it sells its lenses in the open market for rupees 140 per lens. The variable cost of production for each lens is 110, while total cost of production is 125 per lens. So the selling price per unit is rupees 140. Okay, then you have variable cost per unit, that is 110, and total cost per unit is given to be, total cost will include variable cost plus the apportioned or allocated portion of the fixed overheads. What is total cost? Total cost is 125 per lens. 125, that is the cost information, cost and revenue information regarding the lenses. Now the total production cost of a camera by Division B is rupees 400 each. Okay, so total cost per unit or per camera is rupees 400. Okay, then what else? Currently Division B procures lenses from foreign vendors at a cost of, and the cost per lens would be rupees 170 per each. So this 400 includes what? Cost of lens. And currently, from where does Division B procure its lenses? Division B is procuring from foreign vendors. In the sense, at present the lenses are not procured through internal transfer. Okay, so that is the inference. And what is the cost of lens? It comes to around 170 per lens. Okay, then the management of Great Vision has proposed that to take advantage of in-house production capabilities and consequently the procurement cost to be, and Consequently, the procurement cost of lens would reduce. It is proposed that Division B should buy an average of 5,000 lenses each month from Division A at rupees 120 per lens. So the management proposes for, what is the proposal? The proposal is for internal transfer. Proposal for internal transfer. Internal transfer what? Lenses. And how much quantity? Average quantity 5,000 per month. And what is the suggested transfer pricing? Suggested transfer price is rupees 120 per lens or per unit. Okay, so that is the information. Now going ahead, 120 per unit per lens. Okay, the estimate cost of surveillance camera is as below. Now other components purchased from external vendors 150. Basically it is a variable cost. Now cost of lens purchased from Division A, that is 120. See, presently they are procuring it at 170, but this cost breakup is given for what? Is given for the manufacturing of the surveillance camera with internal transfer of the lens. That is why they have taken 120. Okay, now other variable cost is 30 rupees and fixed overhead is rupees 50 per unit, and thus the total cost of a camera comes to around 350. Now each surveillance camera is sold for rupees 410. So selling price per unit is rupees 410. And what do they say about the margin for each camera is low, since competition in the market is high. Any increase in the price of the camera would reduce the market share. Therefore, Division B cannot pay Division A beyond 120 per lens procured. Great Vision's management uses return on investment as a scale to measure the divisional performance. Okay, and marginal costing approach for decision making. Okay, so the performance of divisions is measured. Performance measurement is done through ROI, and decisions is taken through marginal costing. Is it clear? Yep. Then requirement 1. Analyze the behavioral consequences of each division when Division A supplies lenses to Division B at rupees 120 per lens. Substantiate your answer based on the information given in the problem. That is first part. Second part, analyze if it would be beneficial to the company as a whole for Division A to supply the lenses to Division B at rupees 120 per lens. So if Division A supplies lenses at 120 rupees per lens to Division B, will it be profitable or will it be beneficial to the company as a whole? That is the second part. Now 3, do you feel that the divisional managers would accept the interdivisional transfers? Okay, in principle, if yes, calculate the range of the transfer price. Okay, so here you are required to compute the range of TP. You have learned about the formulas for maximum TP and minimum TP. Yes, we have to use that for question part number 3, and we need to find out the range of TP. Advise, fourth one, advise alternate transfer pricing models that the chief executive of the company can consider in order to change the attitude of the divisional heads if they are against the transfer pricing policy. We have learned about different methods to resolve the conflict between the divisions. Okay, now fifth one, calculate the range of transfer price if Division A has excess capacity. So that is it is an assumption, assuming that Division A has excess capacity and can accommodate the internal requirement of 5,000 lenses per month within the current operation. What would be the range of TP? So you have to recompute the range of TP, minimum TP and maximum TP, considering that there is surplus capacity with Division B for meeting the internal transfer. Okay, so this is the question. So you will have to start with the first part. Okay, so you can start answering in that. Sub question 1, behavioral consequences. Behavioral consequence of Division A and Division B. Now the question is, when you talk about the behavioral consequences, you have to tell about, or you have to explain about how this transfer pricing will affect division A and division B and its respective managers. Okay, now there are two aspects which you need to consider here. One is what? The contribution of each division. Okay, what you have to consider in this contribution of each division, you have to compute and you have to explain how this internal transfer will affect the contribution of total contribution of each division. Okay, both buying division as well as selling division. Then there is one more part also. It is given in the question that the performance of these divisions are calculated or are measured in terms of return on investment. Okay, so you have to see what is the impact of TP on the divisional ROI, and what is the formula for ROI? ROI is equal to return divided by investment into 100. Return divided by investment into 100. Okay, so that is the impact of TP on the divisional ROI. So you have to consider the impact of this division, the transfer pricing on these two aspects, and you have to come to a conclusion as to how this TP decision will affect the behavioral patterns of both divisional managers A, the divisional manager A and B. Okay, right. Now how to do that? Okay, now let's take division A first. Division A. What is the peculiarity of this division A? They say that division A has huge external demand for its product, for its lens. Okay, and therefore it is operating at 100% capacity. So what is the inference you can take here? Any internal transfer can be effected only by diverting external sales. Okay, so if they want to do any internal transfer, what is the internal requirement? Requirement is 5,000 units of lenses per month. So if they want to affect this internal transfer of 5,000 lenses, then that much external sales have to be curtailed. Okay, and you know, whenever there is an external sales foregone, whatever be the contribution foregone from such external sales will be an opportunity cost for the selling division. Okay, so let's find out what is the contribution the division A is getting. Okay, so existing or let me write it as contribution analysis. You can write existing and revised, or I will write it as proposed. Okay, existing means no internal transfer. Okay, and proposed means with internal transfer. Okay, now existing, what is the selling price per unit? Selling price per unit is 140. In case of proposed, what do they say? I will come to that. Now minus variable cost per unit. What is variable cost? It is already given that per unit of lens will have a variable cost of 110 rupees. So therefore contribution per unit will be rupees 30. Okay, contribution per unit will be rupees 30. Now what you can do? You can find out what would be the proposed the contribution per unit in the proposed internal transfer. What is the internal transfer price? The management has suggested it is 120. Okay, and what is variable cost per unit? It is 110. So naturally, what will happen? The contribution per unit will come down from 30 to 10 rupee. Is it clear? So that is what happens with the contribution. So you can say that the contribution per unit will fall from rupees 30 per unit to rupees 10 per unit. Rupees 10 per unit. Therefore, total loss of contribution to division A. How much will be the total loss of contribution? It will be rupees 20 into 5,000 is the sale of units. So 20 into 5,000 will be 5,000 into 20 will be 1 lakh rupees will be the loss of contribution. Is it clear? So that is from the perspective of the contribution. Now there is one more perspective. What is that? Return on investment. So you can write that it's given that the performance of each division is measured using return on investment or ROI of the division. Okay, now so you have to find out what is the impact of this transfer price on the return, the ROI. So impact of TP on ROI. Okay, so you have to compute existing and proposed. What is the existing ROI? How do you compute the existing ROI? You need two things for computing ROI, right? ROI is equal to return divided by investment into 100. Now when you say return divided by investment, return refers to what? Profit. Okay, what is profit? Profit is selling price minus cost price, right? That divided by what is investment. In the case of a division, the investment should be in the case of a product, the investment would be its cost of production. So CP, okay, into 100. Okay, if they had given the information about the total investment in the division, then what you could have done? You could have computed the total divisional profit and divided it by the total investment in the division, and you could have computed the ROI, return on investment. But here in the present problem, there is no mention about the total investment in the division. Okay, so here what you can do, you can only find out the product wise ROI, and for the purpose of computing the product wise return of investment, you have to take the profit means selling price minus cost price as the profit and as the return, and the cost price or total cost of production per unit as the investment for that particular unit. Okay, so that is how you compute ROI for products. So existing and proposed, return is equal to return. Existing, it is 140 minus what is the total cost? 125, that is equal to 15. Okay, whereas when it comes to revise or proposed situation, the TP, the transfer price or revenue to the selling division will be only 120, and what is total cost? It is 125 itself. So 120 minus 125 will be minus 5 per unit. So return on investment, ROI, is equal to 15, existing 15 divided by 125 into 100. How much it will be? 15 divided by 125 into 100 will be 12%. Okay, it will be 12%, whereas in the proposed case it is minus 5 divided by 125 into 100, and that will be 125, that will be minus 4%. Okay, so what is the conclusion you can take from the divisional A's perspective? When the transfer price is fixed at rupees 120 per unit and the internal transfer of 5000 units takes place, it is affecting division A in an adverse manner in terms of total contribution as well as in terms of the return on investment. Okay, so the total contribution will fall by how much? Rupees 1 lakh for each month, whereas the ROI for these internal products transferred will fall from 12% per unit to minus 4% per unit. Okay, so you can conclude, okay, from the above, it is evident that the decision to internal transfer of lens at an agreed TP of rupees 120 per lens, at an agreed TP transfer price of rupees 120 per lens, will adversely affect both contribution and return on investment, ROI, will adversely affect both return on both contribution and return on investment, ROI, of division A. Therefore, the divisional manager of A will not be ready to accept the internal transfer as it will affect the divisional performance adversely, Okay, so that is the conclusion. Now you have to do the analysis from division B's perspective. Okay, so first you can write contribution analysis. In that, existing situation and the proposed situation. Okay, selling price per unit or transfer price per unit. What is the, sorry, not transfer price, it is selling price per unit. Okay, because the transfer price will be a revenue only for the selling division, not for the buying division. Division B is the buying division. So selling price will be 410 per unit itself, minus variable cost per unit. And how do you compute the variable cost per unit? Variable cost per unit, in the case of existing, you have the information here. Cost of component, other than the cost of lenses, it will be 150. Then cost of lens. In the existing situation, it is being purchased from the foreign vendors at a cost of rupees 170, whereas in the proposed situation, it will come down to how much? It will come down to 120. Why 120? Because that is the internal transfer price rate. Okay, so cost of lens, and you have one more variable cost. What is the variable cost? Other variable cost of rupees 30. Other variable cost of rupees 30. So what will be the total? Total variable cost per unit will be 150 plus 170 plus 30 will give you 350. and here 150 plus 120 plus 30 will be 300. So contribution per unit. Contribution per unit, in the first case it will be 60 per unit, and in the proposed situation, revised situation, it will be 110 per unit. So what is the impact of the transfer price on the contribution per unit of division B? Increase in contribution due to transfer of lens or internal transfer of lens. It will be rupees 110 minus rupees 60, that is rupees 50 per unit, and total increase will be rupees 50 into 5000. So 50 into 5000 will be rupees 2,50,000 per month. So on account of this internal transfer of the lens, the total contribution of division B is going to increase by 2,50,000 rupees, 2,50,000 per month. Now this is the contribution analysis. Now you have to do the ROI analysis. How do you do the ROI analysis? Again, you have existing and proposed. Okay, so cost per unit. What would be the cost per unit in the existing situation? They say that it is 400 per unit. It is given, right? And in the proposed situation, the cost is going to change. Okay, how does the cost will change? The cost of rupees 400 per unit is computed based on a purchase price for the lens of rupees 170, whereas now in when the lens is procured internally, the cost will be only 120. So this will be 400 is the existing cost. From that you minus whatever be the purchase cost of the lens from the foreign vendors, that is 170, and you add the internal transfer price, that is 120. So that is 400 minus 170 plus 120, that is 350. Okay, and selling price per unit, we know it will remain at a 410 itself. There will not be any change. So return or profit will be 10 here. Okay, and here it will be 60. Now return on investment, ROI, is equal to 10 divided by 400 into 100. So 10 divided by 400 will be 2.5%. Okay, and here it will be 60 divided by 400. No, not 400. The cost is only 350. So 60 divided by 350 into 100, that is equal to 60 divided by 350 into 100 will be 17.15. So what is the conclusion? As far as the contribution is concerned, the total contribution of division B is increasing by rupees 2,50,000 per month, and as far as the return on investment is concerned, it is increasing from the existing 2.5% to 17.15%. So what is the recommendation? You can write recommendation or conclusion or analysis, whatever. Okay, you can write, from division B's perspective, the decision for internal transfer of lens, would be profitable, would be beneficial, not right, don't write profitable, right, beneficial, would be beneficial under that one, would be beneficial under that one, as the total contribution of the division will increase by how much? Will increase by rupees 50 per unit, and rupees 2,50,000 in total per month, and rupees 2,50,000 in total per month. Okay, 2 as the return on investment on each surveillance camera sold will increase from 2.5% to 17.5%. 2.5% to 17.5%. Okay, so what would be the conclusion? Due to the above reasons, the divisional manager of division B, the manager of division B or divisional manager of division B will be happy to agree for the internal transfer of lenses at a TP of rupees 120 per unit. At a TP of rupees 120 per unit. Okay, now what is the problem here? Okay, so with this question is over. Now if you see, there are two divisions, division A and division B. Both these divisions are treated as what? Profit centers. Am I right? Profit centers. So when they are treated as profit centers, the divisional managers of both A and B has the power or has the authority to take decisions with respect to internal transfer, whether or not to accept internal transfer, or the price to be charged for internal transfer, etc. Okay, now if the TP is rupees 120 as we discussed, what would be the decision of A and B managers? Okay, will the internal transfer happen in this case? Okay, now the problem is, if TP is fixed at 120, the divisional manager of A will not be happy at this rate, because its divisional contribution is falling down, and also what? The ROI is falling down. Due to these reasons, the divisional manager of division A will not agree for the internal transfer. Okay, though it is beneficial for division B. Okay, division B manager will be happy to permit, or will be happy for the internal transfer, but as long as division A manager does not agree, the internal transfer will not happen, because there is autonomy for both the division managers. Okay, so on one side, division A does not want internal transfer, the other side, division B need, and the chief executive officer also has suggested, okay, to go for the internal transfer. So there is a conflict between the interest of division A and division B. Okay, so there is conflict of divisional interest. Is it clear? Now what to do? Whenever there is a conflict in the decisions of division, the buying division and selling division, you have to see what? The organizational interest. You see how this decision for internal transfer will impact the division as a whole, or will impact the entity as a whole. Okay, so in this case, you have this the entity Great Vision. How this internal transfer affect Great Vision's profitability or contribution as a whole? Is it beneficial or not? That has to be computed. So if the internal transfer decision is beneficial from the Great Vision's entire perspective, then with regard to, in respect of, or in spite of the conflict between the division A and division B, considering the principle of goal congruence, which states that the interest of the entity as a whole has to be given preference over and above the divisional interest. Okay, if it is beneficial, if the internal transfer is beneficial for the entity as a whole, then division A and division B manager should go for the internal transfer. That is the principle of goal congruence, right? Okay, so here you have to analyze this internal transfer decision from the perspective of Great Vision, the entity as a whole. So you can write the heading. Analysis of TP decision, Great Vision perspective. Great Vision's perspective. Okay, so that is the part number 2, I think, right? So what is part number 2? Part number 2 is analyze if it would be beneficial to the company as a whole for division A to supply the lenses to division B at rupees 120 per lens. Okay, how do you do that? You have to compute what is the benefit that the company is getting at present. That means where there is no internal transfer vis-a-vis in the proposed situation where there is internal transfer. Okay, so the first option, alternative 1. Alternative 1, no internal transfer. Then you have alternative 2, there is internal transfer with internal transfer. Okay, now when there is no internal transfer, when division A manufactures 1 unit of lens, what will it do? It will send this lens in the external market. Okay, and what will division B do? Division B will purchase the required lens from the foreign vendors, and it will manufacture the surveillance camera, and it will be sold in the external market. That is in alternative 1. Whereas in alternative 2, what will happen? A manufactures the lens, okay, which it will internally transfer to division B, and division B will manufacture the camera using that lens, which will be sold in the external market. Okay, that is in alternative 2. Okay, now we have to see what is the total profit or total contribution the company is getting on account of these two strategies. Okay, so that is what we are going to see. So in alternative 1, we will have to take division by division. So division A, transfer of lens. Okay, how do you do that? Selling price per unit of lens is rupees 140 minus variable cost per unit is, what is variable cost per unit? It is 110. Okay, so the contribution earned by division A, contribution earned by division A is as good as the contribution to the company. Okay, contribution per unit will be how much? 30 per unit. Okay, so that is for division A. Now what will division B do? Division B, sale of what? Sale of camera. It is not transfer, this is sale. Okay, sale of camera. What will be the selling price per unit? Selling price per unit will be rupees 410 minus variable cost per unit. What would be the variable cost per unit? Variable cost per unit will be 350. And what will be contribution per unit? Contribution per unit will be 60 per unit. Okay, so as far as division A is concerned, when it sells 1 unit of lens, it is getting a contribution per unit of rupees 30, and as far as division B is concerned, it is getting a contribution per unit of rupees 60 when it sells 1 surveillance camera. So total contribution to the company. Oh, great vision. How much? 30 plus 60 will be rupees 90 per unit. Okay, so that is the existing situation. Now what we are doing, we have another alternative where we are evaluating what would be the impact on the company's contribution if the lens manufactured by division A is transferred to whom? Transferred to division B, and division B manufactures the surveillance camera with this lens and it is sold in the external market. Okay, so here there is no external sale, so you don't have to consider here. So here again, selling price per unit will be 410 itself. Okay, and what about variable cost? Variable cost will be 350 is the variable cost that is currently incurred by divisional B when it is purchasing the lens from the external market. Am I right? So 350, and this 350 includes 170, which is the purchase cost of the lens. Okay, so that has to be excluded, because when there is internal transfer, they are not going to purchase the lens from the external vendors. Okay, so 170 is minus. Now when the lens is manufactured internally by division A, there is a variable cost of rupees 110, which should be added back to the variable cost. Okay, so add 110. So what will happen? 350 minus 170 plus 110. This will be 290. Okay, and what will be contribution per unit? Contribution per unit will be 410 minus 290, that will come to 120. Okay, and what will be the total contribution to the company? Total contribution to the company will be 120. Okay, so what is the conclusion here? The conclusion here is, by effecting internal transfer of the lens, the total contribution to the company increase from rupees 90 per unit to rupees 120 per unit, thereby with an increase of rupees 30 per unit. Okay, now what is the number of units of lenses that is proposed to be transferred? It is 5000 per month. Okay, so total increase in contribution will be 5000 units of lens, and for each lens there is an additional contribution of 30, so into 30 per unit. So 5000 into 30 will be rupees 1,50,000. Okay, so what is the conclusion? The question is, do you analyze would if it would be beneficial to the company as a whole for division A to supply the lenses to division B. So you can write, thus it would be beneficial from the company's perspective as the internal transfer of 5000 units of lens will increase the total contribution of the company by rupees 1,50,000. Okay, so that is the analysis from the perspective of the company as a whole. Now what is the next question? Do you feel that the divisional manager should accept the interdivisional transfers in principle? If yes, calculate the range of transfer price. Okay, so that is the third one. Okay, should the divisional managers accept the internal transfer proposal? Yes, definitely. Why definitely? Because we have seen that by effecting the internal transfer, the overall contribution of the company is increasing by rupees 1,50,000. So the decision for internal transfer is beneficial from the perspective of the company as a whole. Therefore, whatever be the cost, since it is beneficial for the company as a whole, the divisional manager should accept the proposal for internal transfer. Okay, so you can write that as the proposal for internal transfer will increase the total contribution of the company by rupees 1,50,000 okay, comma, the divisional managers should agree for the internal transfer of the lens irrespective of its impact on their respective divisions, irrespective of its impact on their respective divisions. Okay, this concept is what is known as goal congruence. The objective or the interest of the organization as a whole have to be given priority over the interest of the respective divisions. Okay, now third, this one was you have to compute the range of TP, range of transfer price. How do you compute this range of transfer price? Range of transfer price will be minimum TP to maximum TP. Minimum TP from the perspective of the selling division, and this will be from the perspective of buying division. Okay, so minimum transfer price for division A. How do you compute the minimum transfer price? This is equal to variable cost internal transfer plus opportunity cost. Is there any opportunity cost here? Yes, definitely there is opportunity cost, because as far as division A is concerned, the internal transfer can be effected only by curtailing the external sales to that extent. Okay, so the contribution foregone from the external sales curtail will act as an opportunity cost for the internal transfer. So here the variable cost for internal transfer is rupees 110 per unit. Okay, plus what is the opportunity cost? Opportunity cost is the contribution foregone. What is the contribution foregone here? It is rupees 30 per unit. So it will be rupees 30, that is rupees 140 per lens. Okay, so that is the minimum transfer price required for division A. Okay, so in net effect, division A requires the same rate as that it is receiving on external sales, because if the internal transfer is not happening, what they can do, they can easily sell these goods in the external market and get 140 rupees. Okay, so if there is a chance for that external sales, then by effecting the internal transfer also, they should get the same rate. Okay, so that is the logic. Now maximum TP. Maximum TP, how do you compute the maximum TP? Maximum TP from the perspective of the buying division is lower of two things. One, market price of component procured internally. Okay, what market price? Market price from the perspective of the buying division. Okay, or what to the net marginal revenue. We have already seen what is the formula for how to compute this net marginal revenue, or NMR. Am I right? Yes. Now what is the market price of the component procured internally? If the internal transfer does not happen, then division B has to procure this product at rupees 170 from the foreign vendors. So that will act as the internal transfer, the market price of internal the component procured internally. So it is 170. Now here, net marginal revenue. How do you compute net marginal revenue? Selling price of output of buying division. What is the selling price of output? Output means what? The surveillance camera. What is the selling price of the surveillance camera? It is 410. So by buying this the lens and manufacturing the surveillance camera, division B is going to sell the per unit of division the surveillance camera at rupees 410 in the external market. So that is the selling price less marginal cost of manufacturing surveillance camera, excluding what? The transfer price, excluding the TP. Okay, so excluding the TP, how much variable cost division B will incur for manufacturing one surveillance camera? How much? We have already seen that it will be 150 is a variable cost. So this you need not consider because this is the internal transfer rate. Then 30, that is 150 plus 30, 180. So 180. Okay, so what is the net marginal revenue? Net marginal revenue will be 410 minus 180, that is 230 per unit. Okay, so on one side the maximum market price of component is 170 per unit, and the other side the net marginal revenue is rupees 230 per unit, and lower of these two things will be 170 per unit. So the maximum transfer price to be charged is rupees 170 per unit. Okay, therefore the range of TP is equal to minimum 140 to maximum 170 per lens. Is it clear? So that is the range of TP. Now one more question, two more questions. Okay, what is the second the fourth one? Advise alternate transfer pricing models that chief executive of the company can consider in order to change the attitude of the divisional heads if they are against the transfer pricing policy. Okay, we have already seen that if they are against the transfer pricing policy due to some genuine reasons. Here if you see, if the transfer price is affected at 120 per unit, then division A manager will not be agreeable to the TP. And you can't blame division A manager because that this transfer price is going to affect his division's performance, both in terms of contribution as well as return on investment. And he is given specific targets with respect to internal contribution, total contribution as well as ROI. So when he is given targets on one hand, and the other hand you are not permitting him to take decision with respect to performance measures, then he won't be able to achieve the targets. Okay, so you cannot, the entity cannot blame the divisional manager A for not agreeing to this transfer price at this rate of rupees 120 per unit. Did you get my point? So there is a genuine conflict of decision between the interest of division A and division B. So what you have to do, the CEO should try to compromise or to try to bring a compromise between division A and division B, and both should agree to a single transfer price. Okay, for that we have seen the minimum and maximum transfer prices, that range also we have seen. If it is fixed between 140 to 170, somewhere in between that, then it would be advantageous for both division A as well as division B. Is it clear? Yes. So that is the sum and substance. Now suppose those discussions or negotiations are not helping the chief executive to compromise, to come into a settlement or to come into a compromise and reach a negotiated transfer price, then there are some special methods in which the conflict can be resolved. That is what is known as what? Dual rate TP system and two-part TP system. You remember? Yes. In dual rate, what happens is there will be separate rates for both buying divisions and selling division. Buying division will sell at say 140, whereas selling division will sell at say 140 per unit, whereas buying division will account the transfer price say at 120. So something different. Okay, so charging different transfer prices for both buying division and selling divisions is what is known as dual rate TP system. And what is two-part TP system? Two-part TP system means there will be two parts for the transfer price. One is what? One is the variable cost or relevant cost, and the other part will be some lump sum amount for making what? The profit. Okay, so you can use either of these methods to come into a resolution whenever there is a genuine conflict of interest between division A and division B. Okay, I'm not dictating the answer for that because this is a purely theory question, and we have already seen in the last session what do you mean by dual rate and what do you mean by two part, etc. Okay, so I'm just leaving that. Now last one. Fourth one, calculate the range of transfer price if division A has excess capacity and can accommodate the internal requirement of 5,000 lenses per month within the current operations. So that is 5. Okay. So what is the change between this and the previous cases? In the previous case, the what was given in the question was there is no excess or surplus capacity with division A. So whatever internal transfer have to be effected, it has to be diverted from the existing external sales, and that will result in opportunity cost. On the other hand, in the present situation, they say that there is surplus capacity with division A. Whenever there is surplus capacity with division A, the division A can use that surplus capacity for manufacturing sufficient number of lenses for effecting the internal transfer. So in that case, what will happen? There will not be any opportunity cost. Okay, so you can write, since there is surplus capacity with division A, there will not be any opportunity cost for internal transfer. Okay, so what you have to do here, you have to compute what? The range of TP. Okay, range of TP is equal to minimum TP minus maximum TP. That is equal to minimum TP. Here there is no the loss of contribution. So this will be variable cost per unit to maximum TP. Maximum TP we have already computed. There won't be any change in the maximum TP. It will be rupees 170. And what is variable cost of manufacture of 1 unit of lens? It is 110. So range of TP will be 110 to 170. Is it clear? So that is the range of TP when there is surplus capacity. So you can conclude, when there is surplus capacity, with division A, the transfer price range to be negotiated, will be between rupees 110 to rupees 170 per unit of lens. Rupees 110 to rupees 170 per unit of lens transferred. Okay, so that is the range of TP. Right.